Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Sell it all today.
Hello, my name is Nicole, and today I want to talk about how to profit from the market chaos that we have been experiencing since April 2nd of 2025. I want to talk about a powerful option strategy that could potentially amplify your returns in the market. This is using LEAPS as a stock replacement strategy. LEAPS, or long-term equity anticipation securities, are essentially options contracts with expiration dates that are more than a year away. They allow investors to gain exposure to stocks or ETFs with significantly less capital than buying the underlying securities outright. This strategy is remarkably straightforward. Instead of buying and holding stock or ETF shares directly, traders will purchase call options with expiration dates that are more than a year away. This approach simulates a buy and hold position, but with built-in leverage. The key benefit: when the stock or ETF goes up, your percentage returns are magnified. Of course, there is a trade-off. When the stock or ETF goes down, your losses can be magnified but are limited to the premium paid for the call options. This strategy isn't about eliminating risk, but about strategically using leverage to potentially enhance returns. So let's talk about what underlying assets are good candidates for call leaps. Stocks and ETFs that offer long duration call leaps with liquid markets. So liquidity is the key, and the stocks and ETFs have to offer options that have longer dated durations. So while applying this approach to individual stocks can offer higher returns, the concentration risk makes it more dangerous. ETFs like SPY or QQQ offer diversification while still capturing growth potential. Let's talk about selection parameters for the call leaps that traders purchase. First, let's discuss delta selection. Traditionally, traders will select strike prices with deltas between 0.75 and 0.90 or 75 or 90. These options have less extrinsic value, which means they experience less time decay, and the higher delta options will behave in a stock-like manner. Experienced traders can look to buy options with deltas that are anywhere on the chain. At-the-money options can be a more balanced approach if traders plan to be more active with a position, and lower delta options, anywhere between 0.25 to 0.40 or 25 to 40, offer maximum leverage, but 100% of their value is extrinsic. As a result, these positions need to be more actively managed. Now let's talk about expiration time frame. You want to look at options that have at least 365 days to expiration. I oftentimes like to trade leaps that are kind of around the 600 plus days to expiration timeline. There are leaps on some ETFs that are offered all the way out to 900 and 1,000 days to expiration, but I find that those options are less liquid than the ones in the 600 plus range. This gives us time for market assumptions and positive drift to play out in the marketplace. It also minimizes the impact of time decay and allows a trader to hold a position for longer than a year if they wish, in order to minimize short-term capital gains taxes. And what market conditions are we looking for when we want to purchase call leaps? Well, obviously, these are best implemented during significant corrections right before a bullish move in the underlying. It's important to note that implied volatility is typically elevated during these significant corrections, but the extended time frame helps to mitigate this impact. Risk reward is most favorable when fear is high, sentiment is low, and liquidations are occurring. So this would be a good time to consider this strategy, which is why I'm putting this video out right now. Position sizing. Because of leverage, you want to consider sizing the position smaller than you would with shares of stock. And a good rule of thumb for many traders is to commit no more than 25% of what you'd invest in shares to this LEAPS strategy. And many traders actually commit less than that. So I want to go through a real world example of how these LEAPS can perform. And in order to find a comparable time frame, let's revisit the market sell-off during March of 2020. So as we can see in the chart here, the first 3 weeks of March in the year of 2020 were fairly tumultuous. We had a very significant correction in US equities. So I want to go back to the Thinkback tool and populate the ETF SPY. And we're going to bring up some dates here in March of 2020. And I'm just going to selectively pick 3 or 4 different options sprinkled throughout the first 3 weeks in March in order to mimic what I might do in the middle of a market sell-off. So as stocks are selling off, I'm going in and purchasing call leaps, not knowing when the bottom is, not knowing when there might be a turnaround. So I'm going to gingerly go in and select 3 or 4 strikes here to build out the position so that we can analyze how these leaps performed in the days and months afterwards. So there I bought the at the money 275 strike on March 10th, 2020. Fast forwarded to March 17th of 2020, and it looks like the market had fallen further. The at the money for that one is $240 for the strike. And let's go to March 20th. Well, it says non-trading day on March 20th, so it's showing us the 21st. And we're going to purchase another at the money, this time the 230 strike. Now we selected those options, and those options cost us anywhere between $3,200 and $3,900. And let's fast forward to April 18th, 2020. And we can see that the market had rebounded, and those are showing profits. That box shows the profit of each individual option as we fast forward through the various monthly expirations just to see how those options would have performed. And we can see that as we fast forward through the options, as the market has moved upward, those options are making money. Okay, now we're at December OPEX here of 2020. And things are looking pretty good. We're pretty happy with this position. Fast forwarding to March. April, May, June, and the profits keep going up, and July. So you get the idea. The options are performing and doing well as the market is moving up. Okay? So let's assume we held those options almost until expiration. And so for the back testing, I actually selected the December option expiration, which would be a month before these options expired. And let's see what our performance would have been. So for a total cost for the 3 at the money leaps during March of 2020, just randomly selecting 3 leaps and buying them as the market was falling, we had a capital outlay of $10,588. And by the time these options were 1 month away from expiring, our total profit, if we chose to realize that on December 18th of 2021, would have been $53,187. And that would be an over 500% return. So definitely not too shabby. Let's talk about how we would manage the position. So once you've established your position, there are several ways to manage it. First, you can simply choose to hold them till near expiration. This is a simple approach. and maximize its potential upside. One thing I would like to have you consider would be to rolling to a new LEAP somewhere between 60 and 365 days remaining until expiration. And whether you choose to hold until 60 or you choose to roll at 365 depends on what kind of delta and extrinsic value is left in your call option and if you need to minimize the theta decay of those strikes. Really deep in the money options, this is going to be less of an issue. So if you bought options that were either deep in the money to start with or were at the money, and as the market moved up, they're significantly deeper in the money, rolling to control theta decay is less of an issue for you, and you may choose to hold those options till closer to expiration. Another way to manage a position is to consider taking profits after a significant move. Some traders set target profit percentages. Some traders consider partial position exits. And my favorite approach is to lock in partial profits by rolling calls up to a higher strike for a credit. Another thing many traders like to do is add income by selling shorter dated covered calls, call credit spreads, call ratio spreads, and covered short straddles against the LEAPS. This is a very popular strategy. Selling covered calls creates what's known as a diagonal spread or a poor man's covered call. Selling shorter term option premium against the LEAPS helps to reduce cost basis, but be aware that selling call premium caps upside profit potential during aggressive market moves to the upside. And finally, hedging. I like to hedge these positions with put debit spreads. This offers additional protection in uncertain markets. It creates a defined range of outcomes, but it does cause a drag in the portfolio and reduces overall profit potential. And a lot of times if I'm selling shorter dated option premium against my call LEAPS, I am trying to create a neutral carry situation in which the profits from those premium sales are actually used to purchase the put debit spreads for hedging the portfolio. So let's go through some key takeaways here. LEAPS work best when purchased during significant market corrections or just before bullish price action. The DTE timeframe is crucial for giving time for your thesis to play out and to minimize the impact of theta decay. Strike selection depends on your risk tolerance, objectives, and capital constraints. This strategy obviously performs very well in V-shaped recoveries, and active management can enhance returns. It's important to note that this strategy isn't for everyone. It works best for investors who have strong conviction that a stock or ETF will trend upward over time. They can tolerate higher volatility and deeper drawdowns, and they have sufficient capital to implement the strategy properly. Options traders who are comfortable with basic options mechanics and rolling positions will do well in this strategy. If you found this video helpful, please hit the like button and subscribe for more options and investing content. Drop any questions in the comments below and I'll do my best to answer them. Thanks for listening.